Theodore O'Neill is the CEO of Litchfield Hills Research, and he's been a sell-side analyst since 1996 and worked for 10 different investment banks, 7 of which no longer exist. So that's not a shock. He was around during Lehman. During his career, he won the Wall Street Journal All-Star Award in 2000 for calling the downturn in the semiconductor capital equipment industry, and was a ranked analyst in Institutional Investor. Prior experience includes 6 years as a PM, CFO for a defense contractor working on the Star Wars laser weapons program. That's pretty cool. And a senior financial strategic planning positions for 2 high-tech public companies. He was trained as an electrical engineer, has an MBA from Indiana University, a BA from New England College, and an AE from NHTI. I'm not sure what that is, but I am impressed, Dale. Next is Charlie Phippen. So Charlie is the CEO of Water Tower Research, and they are a global leader in the financial industry. Charlie has more than 25 years of experience across investment banking, sales, trading, and equity research at leading firms including Goldman Sachs, UBS, and BNP Paribas. He has successfully built and run numerous businesses across financial markets. Most recently, Charlie was the COO at Water Tower Research before being promoted to CEO. Prior to Water Tower Research, Charlie was the Chief Operating Officer of Market Structure and Technology at Greenwich Associates, an S&P company where he drove profitability by managing operations, sales, and marketing. Prior to Greenwich, Charlie was the Director of Product Management at IHS Markit, developing and expanding its suite of analyst research offerings for the financial markets. He has also held management positions at BNP Paribas, UBS, and Goldman Sachs, overseeing equity, derivatives, and investment banking. Phippen received his BA in Business, Economics, and Psychology from Lafayette College. And last but certainly not least, Mark Pellegrino. So Mark is the CEO of CorpAx, the industry leader in corporate access and research management solutions for the investment community. He is responsible for the strategic vision of CorpAx, as well as the day-to-day operations of the company. Prior to CorpAx, Mark served as the head of market solutions at Balsani Asset Management, where he oversaw broker relations, the firm's corporate relationships, and its response to MiFID II. He integrated the sourcing of broker content, corporate access, and alternative data into one team to help the firm source, value, and pay for content critical to the investment teams. Prior to Balsani, Mark spent over 10 years in corporate access, most recently as head of corporate access at UBS Securities, where he built extensive relationships with the corporate investor relations community and at Deutsche Bank. Prior to that, Mark currently lives in New York, where CorpAx is headquartered, and is a graduate of Princeton University. So, and long story short, I knew Mark a billion years ago when he was at Thomson.
That's right.
So now we're going to jump into the questions. And by way of background, the panel felt that it's important to give everyone an overview, if you will, on MiFID II. And I'm going to start with Mark. So Mark, can you explain what the heck is this MiFID II?
Yeah, I drew the short straw, but I know Charlie and Theo are going to check me on this. But so here's the way I kind of think about MiFID II. So prior to all these changes, if you're an asset manager and you consume research, you basically had to pay for that research, and you did that in the form of trading, either direct trading or in some cases soft dollar trading, where you traded with a large broker dealer who then cut a check to someone for you. So that's traditionally been the way that asset managers pay for research. And apologize, I'm getting a little bit of feedback. So I don't
Jonathan,
know
I think you need to go on mute.
Oh, that's better. Jonathan was. Thank you, Theo. So obviously you could trade to pay for research. The problem with that is there wasn't a lot of transparency in these costs, and so the European regulators basically said, look, we need to shine a light on this. We need to increase some transparency around what these costs are and what we're actually buying with these. Because let's say the fund was up 10%, the actual underlying investor might earn 7%. So what was that 3% doing? And their answer to that was to say, well, look, how about we break out the costs that the things that you're buying to drive your investment process and manage that separately. And that's why you often hear the term unbundling. So they basically unbundled trading from direct payment of research. And so the end result was a lot of asset managers saying, okay, fine, we're now going to break this out as a separate process, and we're going to buy this research, this corporate access, this content, whatever it is, directly, and we're going to write checks. And then they had the option to either pass the cost of those checks back onto the underlying investor, although a lot of investors just started absorbing those costs in the management company as well. The problem with this is the SEC has a very inconvenient rule that broker dealers in the US cannot accept checks. So you have this global regulation where Europe's saying, no, if you're going to buy research, you got to write a check for this. And you have the SEC saying, well, look, if you're a broker dealer, you can't accept checks. You have to trade for these services. And so it's a kind of perfect example of global regulatory bodies not really working together. So the SEC's solution for this was basically to say, listen, we're going to put out a no action letter. We're going to leave this alone. Go do your thing for a while, but it is going to expire someday. Just figure out a solution. And kind of everybody ignored it and said, oh, great, here's the new normal. Let's set this up. And then the SEC said, no, we weren't kidding. This is going to go away. And you are no longer going to be able to write checks for this research in the US towards broker dealers. And that's where we find ourselves today, is everyone kind of said, wait a second, we thought we were good. We set up a new, the new normal, not the case. And so underlying this, there's really two solutions. Either the asset manager figures out a way to pay these broker dealers either through trading or some kind of something that's legal in the eyes of the SEC, or those broker dealers have the ability to re-register themselves with the SEC as an investment advisor, which is a huge pain in the butt, and very few broker dealers have done that to date. So maybe I'll stop there, and Charlie, Theo, please jump in. But that was kind of my quick way of saying kind of how we got to today.
Yeah, no, I think that's a good summary of it. Just leveling the playing field is how you have to think of it. And, it's decades, and we've seen this over and over again, decades of regulations and changes that occur. And now that we become more of a global economy, we have different government agencies and regulators that kind of conflict with each other. And that's exactly where we stand with MiFID II, right? So MiFID II, obviously, we don't have US broker dealers that can accept checks. And so the no action letter came out. Again, that was in 2017, I believe, Mark, right before MiFID II came out in 2018. So we've had I think we're going to have a full 5 years. And Mark, you said it 100% right. It's a lot of people were like, we'll just forget about this. They'll keep kicking the can down the road with the no action letter. And the SEC, if you look at it, does do that with some other regulator issues across the globe. This one, they were like, no, we've given you enough time. This is time for you guys to figure out what you need to do. And that's really for the buy side and the sell side to just play nicely in the sandbox and figure out who's going to do what and where do people stand with it. So that leveling of play field, I think ultimately is probably a good thing for the markets. It just causes, short-term turmoil among the players on the field. So, and then we can discuss a little bit later where we think it's going to go in the future, but I'll let Theo chime in a little bit.
Yeah, I think we need to go back and sort of look at the history of equity research, which is, before 1975, when trading commissions were fixed. Trading commissions were pretty large. As a matter of fact, you could trade, the cost to trade 400 shares of a $40 stock back during fixed commission times on an inflation adjusted basis is worth equivalent of a month's rent of a 1-bedroom apartment in Brooklyn. I happen to have my Tucker Anthony commission calculator here.
Nice.
And the commissions were pretty rich, and it was a great business. So what the investment banks did then is they decided they'd write research as a way to differentiate their product from all the other companies that were out there. And this sort of set the stage for regulation exemption for investment banks, because this was considered a free good. But what happened is, when commission costs were deregulated in 75, you had to now find a way to sort of cover the expense of your research department. And in the 80s and 90s, the way they did that is you tied them to the investment bankers. It made the analysts bankers as well. I remember those days. Those were great. And so the banking ended up funding the research department, which again is sort of a loss leader. But when it was hitched to investment banking, it worked pretty well. Worked very well hand in hand. After the tech bubble in 2002 and the global settlement, investment banking had to be separated from research. And so now research became sort of like, where are we going to stick this loss leader? And so we've been struggling to try to figure out how to get paid for research for decades. And it's the money has shrunk, the commissions have shrunk, the number of clients have shrunk. And so now to get paid, directly for research, which is sort of the equivalent of being an investment advisor, the SEC is saying, well, you should just register as an investment advisor, and that will settle things. I'm not sure that that's going to be a good answer for the investment banks, but that's sort of the history of how we got here and how it started out as this free good, which wasn't getting paid. It was just loss leader to connect with other parts of your business, and it's just been a struggle for decades.
I'd add one more thing to that, because Theo's spot on in the evolution. But when I was on the buy side and managing this, we also had the issue of wanting to trade low touch more, algorithmic trading, quantitative trading, and the population of people that do that well gets even smaller. And so if you're trying to save money, you're really trying to push a lot of your trading through very few brokers. So what do you do with the rest of them that you're consuming content from, research, etc.? You got to write them checks. You got to put them on fixed services. Sometimes that's fine as an independent research provider. Sometimes those guys are broker dealers. And now you run again into this problem of like, I'm trying to write a check to somebody because I can't really trade with them because their trading's not so good, or they got rid of their trading desk. Now I've got to find a way to do that. The SEC points to soft dollars as the solution to that. And obviously the European regulation says, nope, soft dollars don't work. You have to have an alternative method to do that, which is hard dollars, basically.
Yeah, and so I think compounding this, I think, is the fact that before 2002, anyone, if you're a sell side analyst, anyone could be a client. I mean, even if Fidelity wasn't your account, if you went to Fidelity with a good idea and they liked it, they just simply do some business with you. But that started all getting restricted after 2002 to what you were saying, Mark, about having fewer and fewer banks that you're willing to do business with.
Yeah, I'll add to that, and we keep going back and forth. But that's a big thing for investor relations, because the same thing used to be, and I started running roadshows in like 2004. There was never this issue of this person's not a client, right? You'd go out, everyone was a client, anybody could go on the roadshow, they'd raise their hand, and then obviously, you talk to the company about who you set that meeting up with. This is a much bigger problem. And you see this on IR forums and other places where people doing, especially European roadshows, the brokers are now saying to them, oh no, that target list you have, these 5 guys aren't clients of ours. We haven't set up a relationship. We don't have a approved broker relationship, which is part of MiFID to have approved brokers and all these things. So it's really challenging as a corporate because you don't have a clue. You don't know that this broker works with these 20 clients, this broker works with these 30. And of course, the brokers aren't going to really tell you that. They're going to get you on the road and then try and convince you to see their clients, as opposed to maybe who's the best person to own your shares or who the best meeting is. And that's becoming kind of a real problem today that is just going to continue to be an issue as we move forward here.
So that is a great backdrop. And with that, so let's dig into this a little and do some time traveling to July 23, and the SEC lets their no action letter. And Theo, I'm going to start with you. What do you envision happening to both, the sell side and corporates, post July 2023?
I think that a lot of this doesn't apply to the bulge bracket firms, but for a lot of the smaller investment banks, I think they're going to throw in the towel. I mean, it's hard for me to imagine going to the board and saying, hey, We want to register as an investment advisor, bring that regulatory regime into our business we've never had to deal with before, hire the staff to manage that, and take this research department, which was a lost leader all along, throw it into this new organization, and in the hopes that we get paid. I don't see anyone going before their board and making that case. And so I think we're going to lose. I think we'll lose a lot of coverage. And I also think back to 30 years ago. I had a meeting with Ken Langone, who was, everybody knows who he is, I think, here, and he was running an investment bank called Invamed, and I was the only analyst covering one of the companies that he had just underwritten. And I went to him to talk to him about starting up a research department, and he said, "Why bother?" And I think that a lot of these investment banks are going to say, why bother anymore? We know we're making money with banking. Jonathan, you need to go on mute just briefly. Thanks. They're making money with banking. They're making money with trading, obviously less and less over time. And then you've got this other thing, which is going to get encumbered with more regulations. I just don't see how it survives.
Charlie, Mark,
just to
anything?
throw that in there, corporate access, generally speaking, is the number one thing that the buy side cares for, the big firms,
100%.
especially on the hedge fund side. Part of the MiFID regulation was, oh, guess what? You can't pay for corporate access anymore. So the single thing that asset managers value the most, and it's, research tends to be a somewhat close second to that, but corporate access comes up. By the way, my company runs more broker votes than anyone on the planet, so we see this, and it's definitely the number one thing people talk about, especially hedge funds in the US. Well, now they can't pay for it in Europe, which is just another ding to the brokers on a service that, was highly coveted. In some cases, that's increased the value of research, where they've shifted some payment into research quietly. But the reality is it's been a net loss for the brokers in a big way in Europe. But in the US, hedge funds can pay whatever they want for corporate access who aren't under the MiFID umbrella. So it creates a very uneven playing field, which is kind of what Charlie was getting at. You have these hedge funds that are just like, I'll pay for whatever I want, ever how much I want. And then you have bigger global asset managers, in a lot of cases, long onlys, that just can't compete with that. Again, big impact for corporates, right? So when we started out doing roadshows 15 years ago, we didn't really care whether it was a hedge fund or a long only that took meetings. Now that dispersion in payment around corporate access is bigger than it's ever been. And for a corporate IR, you have to have a much, much stronger hand in terms of who you're going to meet with and why, because the economics are imbalanced in a way that, like, the broker and your incentives are no longer aligned as much as they were 15, 20 years ago.
Yeah, I'll just chime in on Theo's comments there on sort of what happens in July. I think ultimately it's right. It's going to become more of a lumpy business. There's 12 large brokers out there. They're big, they're powerful. They're going to continue doing investment banking. They know they can make a lot of money off of investment banking. They always have. This research business that has always been there, that's very helpful for the corporate side of things, but only if you bank. So only if you really participate in their program. If you reduce the size of the sort of investment banks or large players out there, then the smaller mid-tier firms, they don't have global offices. They're not going to probably register as an RIA, and then therefore there will be some compression on the equity research side of things. That's really, frankly, where our business cropped up, is we are an alternative. What's the alternative? Is most IR folks are asking about corporate sponsored research, which has always been sort of a negative word, a bad word in the market. Is our business is really founded off of saying, how do you do this? Like, what is the alternative? We hire equity sell side Wall Street analysts to produce research just the same way they did in the investment bank, but now they're not in a broker dealer. And now we're MiFID II compliant. And now we have all of this distribution, and there's no lists required. There's nothing, there's no I'm your client or not your client. And that's sort of how we've seen this market evolving, is that our business, hopefully, we're in it, is to get larger and bigger and take up more market share for those companies that just become orphaned. That's a word that we use quite a bit at our organization, is those orphaned organizations that were on the tier, they were sort of covered, but not covered. And now a lot of those will drop down and say there's no coverage because you really can't do any banking with folks. But So 2023 will look a little different. I think from the SEC standpoint is they gave us 5 years to figure this out, and we really should have. And then a lot of folks, like Mark was saying, is like, oh, hopefully they'll kick the can down the road and it'll be status quo. Status quo tends never to happen like we want it to. So, the market will need to figure itself out at some point, and they're just going to force our hand at it. So yeah, consolidation will occur. I don't think, big investment banks are not going anywhere. We need them. They're integral to our environment and how capital markets work. So it's just sort of the research side of the business will be consolidated. So.
Yeah, I'd add to that. I think that's spot on, and I think it's hard to kind of generalize because someone with more knowledge of this than me could get in the weeds on every single broker dealer and say this one's impacted more than that one. But I kind of take the view that a lot has been changing because of MiFID, and you kind of wake up one day and you look back and you go, wow, things have already changed. Coverage has already dropped. There's been a ton of M&A on the broker dealer side, and that's going to continue because the economics don't really work for everybody. And I think you're also seeing this crazy talent shift, right? Of lots of sell side analysts going into IR and going onto the corporate side. We've seen that a ton. We're seeing a lot of talent on the sell side move to the buy side. So one of the answers, if a firm like Charlie's didn't exist, the buy side could say, well, fine, we'll just bring research in-house. It is not cost effective for most of these guys, right? Very, very big firms can do that. They can hire people, pay them a lot of money to do more research. So the PM used to have 2 analysts, and maybe now they have 5, right? We see that at big hedge funds, but the tail cannot support that. The model worked. You needed the sell side to do this research for you. It was cost effective. So you're also seeing the big firms on the hedge fund space get bigger, and the smaller guys, it's just a lot harder, and they're going to need to be able to rely on maybe firms like Charlie's or just other sources to get research from. I think that's an interesting thing to keep an eye on, right? Just kind of how the buy side evolves and who's got the money to actually grow and invest, where others are very, very challenged by the loss of access to some of this research that they can no longer afford.
Yeah, and it's interesting. So if you're thinking from Mark, I don't know what your opinion on this. So if you're thinking from an IR standpoint, right, you're an IRO at a sort of small, cap type of organization. What do? You're trying to struggle to get attention. If the larger sort of investment banks are consolidating and even getting bigger, that's harder to get attention from them, right? So you're not going to do a ton of banking with them or anything like that. So how do you deal with that in an environment in 2023 where some banks will be like, yep, research gone. All of a sudden you got a whole division's going, and that was your guy that covered you, and you're the IRO sitting there like, now I'm left with nothing to do. So, the market will shift quite significantly. I think nothing happens immediately. It happens over time, and people will hopefully adjust earlier than later. But, that's interesting for everyone on the call to think about. If you're an IRO, is, what do I do next? Is, you really have to think about who your partners are, who you're banking with, folks like Mark that can help as far as, corporate access goes, our firm and so forth. So it's an interesting dilemma.
There's a question in the chat, and the question, I'll read it. So is the implication that as corporates, we need to do a greater level of investing, targeting, and outreach on our own to ensure we're getting access to investors best suited for investing in our company? And Theo, I'm going to let you lead that one off, and then the other guys can.
Yeah. So I think the answer is yes. It means, and there are a lot of different ways to target investors. There's a lot of different programs that you can use. I mean, from the very basic, looking at the shareholders of your competitors, but there are other more sophisticated ways to do it. And it will require, like so many things, more work for the IRO as these things evolve, and doing more outreach for yourself or hiring others to help you with the outreach is going to be important. I mean, one of the things that we keep track of is we know what institutions read our research, because we get that information back from the financial platforms that our stuff's published on. So we give that back to the client as part of their targeting for their own targeting efforts. But there are lots of other ways to do this as well.
Yeah, if I can follow up on that, the answer is yes. I think the hard part just in your traditional investor targeting, and Theo touched on this a little bit, like you can look at shareholdings, you can look at peer holdings. A lot of that's backwards looking. What Theo's talking about is actually potentially forward looking information, right? Like what is the process that an investor goes through? They start to read the research, they start to consume models, they start to do a little bit of work, they reach out and meet with management. That's what's always been missing in the corporate side, is there's just no good tools out there for forward interest. I think there's some things that are in the works from a tech perspective that will help solve that. I think we'll be part of that solution someday. But the answer is you're seeing the buy side not just sit there on their hands and do nothing. So the smart firms are actually hiring their own people. They got their own corporate access teams. And that's not just about like, hey, let's go set up our own meetings. It's really about giving you a point person to talk to understand a very complex organization, right? The buy side's gotten a lot more confusing. All these long onlys have hedge funds inside of them. They all have quant investors inside of them. It's very difficult to look at a 13F and know what the heck's going on and who the right person is. So firms like Wellington and Capital and T. Rowe and, BlackRock, et cetera, they've all hired people. That's all public knowledge. They've got people there that you can call and say, listen, do you want to meet with me? Who would meet with me? Do you care? And is that something I can do through a broker? And they're actually open to using brokers. These people are not trying to cut brokers out. That's a concern brokers bring up a lot, but that's not what's happening. Their consumption of broker corporate access is only increasing. They're just there to say, here's how you work with our firm. Here's the people that care and can give you a real-time answer on, is this a good time to meet or not? And so you got to know who those people are. And certainly all of us can help you with that because we're talking to those folks regularly.
I'm going to use actually, Mark, to your forward-looking statement. I like that a lot, actually, because that's exactly what we're doing. We do something very similar to what Theo's doing, right? So we start with the content. You asked, do you need to have greater level of investor targeting? That's exactly what we do. And our model is that we start with content from a credible source, right? So a sell-side equity analyst that is writing the traditional equity research on you, you distribute that. Our firm, just like Theo, I believe, sends it to all the institutional platforms, FactSet, Refinitiv, CapIQ, Bloomberg, and so forth. So we get all the readership data. We send it to all comps, social media, all RIA lists. I mean, we send them far and wide. And then that data is what you guys are looking for, right? So our firm likes to work with folks like yourself and engage with you and say, okay, here's all the data, all the readership, if Mark Pellegrino's opened 10 pieces of content, pretty good odds that he's interested in your organization. Let's take a look at him. Let's see whether or not he's a valued investor, what he's done in the past, and so forth. So our business model is actually to fill the gap that assumingly is going to come in 2023. We're just, we're starting it up now. So
I'm going to seize upon that. You mentioned 23, and I'll start with you. So how quickly after July do you think is it like flipping a switch? Do you think some people will kind of test the SEC limits and see how they, is it going to be flipping a switch?
Yeah, I don't know. The investment banks aren't known for excellent management skills. So I'm really not sure how quickly this is going to unwind. My guess is that the better run firms are going to be debating it sort of here at the end of this year about as they plan for next year, and they'll come to some conclusion about it. I mean, if they knew they were going to shut it down, you probably first see it by bonuses being cut. And then what happens in July? I just not sure. But if this was a regular corporation that had employees that made things, you'd know exactly what would happen because it would all get planned in advance. Okay, we know we're going to lose X amount of. We're not going to do this business next year, so we can just start shutting this stuff down now. But investment banks don't really work that way. Everyone tries to avoid making any decisions that disrupt the status quo until the last minute, and then they, in my case, 7 of them went out of business. So I think we'll see a lot more of that than, and that's what I would guess. I rather than speculating on a time frame because I think they wait till the last minute.
Mark, Charlie, any comments?
Yeah, I mean, it just comes down to a math equation for each of these businesses that they run, right? So if they do the analysis on RIA, or they're hoping for whatever reason that the buy side is going to pick up and start, attributing their trades and allocating cash from that perspective, no one knows that answer. My guess is the buy side's probably not going to do much from that perspective. They're going to wait for the banks because they have more money and they can absorb whatever expenses need to happen. But ultimately, they're going to sit back, and the investment banks are going to say, I have a research department, it costs X. What does it glean from the market as far as revenue goes? Not much. Okay, then we need to trim this down. Or is it additive to certain sectors? Healthcare and technology tend to be huge banking sectors, so potentially you keep those sectors going and other sectors get unwound. It's going to be sort of not going to happen immediately. We know, and I think Mark and Theo probably knows as well, that the banking sector, it runs in pendulums. They either overhire and then they fire everyone, and then they overhire again and then they fire everyone. It just happens that way for whatever reason. I'm not sure why that occurs, but they just love doing that. So I think you're going to go into a season, a bonus season, that's going to be pretty rough on the capital markets, especially on the research side, because they're all doing the math right now.
I think it'd be interesting to ask your coverage, because again, it's very specific. Like if you just had to guess, I would think that US based firms who have kind of been tier 2, tier 3, but always trying to be tier 1, like, hiring, trying to cover a lot, having big businesses, but maybe don't have the quality of the trading desk. So they started collecting a lot more in checks. They're the highest risk to me. Now, who those are, I don't know. We can't name names, but I might start with your coverage and say, I got 5 banks covering me today, maybe 10. Who are they, right? The bulge, you're probably okay. I don't think they necessarily go anywhere, but they're under just as many pressures. They're not getting bigger. They're not covering more stocks as far as I can tell. But ask those guys, ask the analysts. I don't know if the analysts are even aware of this stuff, but they should be. It's just, is your firm doing anything around this? Are most of these guys trading with you? Are you collecting checks? Like, you can almost come up with a list of maybe who's at risk of your coverage, because that's what I'd be most concerned about. And then obviously you're just going to run the risk of, you're not going to have a whole lot of new guys probably picking up coverage. Unless the firms like Charlie's firm and others can fill that void. I mean, I think the market needs that, right? So that's the other thing to watch.
That's a great idea, Marcus, for these IROs to go out there and just start talking, be more verbal about what's going on in the marketplace and really getting a good understanding. What you'll find is there won't be a cliff. There'll just be more analysts doing more with less, right? So if they cover, Theo probably knows this better than I do. If they used to cover 15 names, more recently, it's gone up to 20 names per average. They could be up to 50 names. And so what is that to you as a company? Probably not much, because you're just getting coverage on the quarters and maybe some PR stuff, an update note or something that really is not that helpful. So even though you see, hey, I kept my coverage, that's great. But now how many names is that guy coverage, and are they really doing anything for you as an analyst? And I don't know, Theo, do you have any comments on that?
It's my experience. The analysts are the last to know.
Yeah.
What's going on internally.
Yeah.
And there's no sell side analyst can cover 50 companies. It's not physically possible.
That's right. That's absolutely right.
Well, and that's one of the major changes, right? Is they want the brand name II guy at the top, but they're covering 50, 60 names. And are they really knowledgeable? They're not. They've got a bunch of juniors that are the person behind the scenes on that. So I think that's every company has a problem. If you've got 30 analysts, you're complaining because a bunch of them aren't doing real research, right? If you're a small company, you got 3 analysts, you're complaining because you don't have enough analysts. It's probably very few companies that are like, I got the perfect mix of coverage and partners on the sell side. But it'll be interesting to see how that plays out.
Yeah, I mean, I think there's 11. I did a TAM for our business, total addressable market for our business. And I think there's something close to, let's call it 11,000 or 12,000 publicly traded companies. I think of that, surprisingly enough, 6,000 or 7,000 of them have zero coverage. So a lot of them micro, pre-revenue, stuff like that. But there's a big meat of them that really don't have any coverage, and they're sitting there like, hey, I need some attention on me. I need to control my narrative so people understand the inflection points and the investability of my organization. And then you have a whole bunch, at least another couple of thousand that only have one or two names. And then up there, you get the mega caps that have, I think someone mentioned Meta in a conversation I had, they got 53 names, really 53 names. They're covering Meta. So that's not helpful at 53 either. So it's just interesting. It'll definitely be interesting to see what happens in 2023, but that decision-making process is happening now for sure. And I think people are still waiting to see if SEC might make some more comments later this year, towards the end of the year, maybe the beginning of January. So
the other thing that I see a lot of, it's very difficult for a new young analyst to break in now. And, it used to be the power of the big firm comes out and, gets the name out there and you take meetings. The buy side just has a much bigger reason to actually minimize the number of people that their firm talks to. It makes it easier, right? You have these teams that manage payments in the middle, and I was on one of these teams. Like every time a new broker came along, it was like, oh, great, we got to set up a payment. We got to figure out who cares. It was like, it's a ton of work. So the hurdle, the bar has gotten so high to letting these new broker dealers, new research providers, independent, et cetera, into the firm. And then that just means it's harder for them to get, credit with the PMs and analysts and actually break through. So it'll be interesting. That's why the big names on the research side are still making a ton of money. Because if you're already there and you're at the top of biotech or internet, whatever, those guys are still getting paid just fine. But it's a probably steep curve down and a long tail from there. There aren't many of those guys left, and it's real hard to bring the next generation along.
So there's a question in the chat from Sharon, and it kind of dovetails with the last question I have for you guys. And two of the three people here, Theo and Charlie, do run paid research firms. And lastly, and I'm going to start with you, Charlie, how do you envision this change impacting your firm? And then we'll hear from Martin.
Well, the easy answer is to say it should impact it quite significantly, right? So we should see more business. And we have, to be honest with you, this year has been a good year for us as more and more IROs look at the landscape, look at how they're creating content related to their business. We call it content for a lack of a better word, just meaning that it's equity research on your business, and it's a full equity research report too. There's a lot of corporate sponsored research businesses out there, and Theo knows them. There's just people cropping up and they write a report, and then it's a single report that doesn't go anywhere. Our coverage tends to be more holistic in nature. It's a full year coverage of, we do fireside chats with the management team. We go deep into the management team. We get the data. We set up, non-deal roadshows and so forth. So overall, I feel like this is going to be very impactful to a business like ours. That's our hope and our goal. And so the way we're trying to build our business is off of credibility and only hiring Wall Street analysts. We're not offshoring. We're not doing any of that. Our analysts will probably only cover, Theo, maybe 10 or 12 names at best, because we really try to get in bed with the IRO and really work with them well. So I would probably see more companies like this propping up and people getting more and more comfortable with the corporate sponsored research side of things and having that less of a bad word in the marketplace, as opposed to, maybe a year ago where people are like, there's no chance I'm going out and doing that. So Theo, any thoughts on your side?
Yeah, so we, just like you, we get the reports from Bloomberg and FactSet, Refinitiv, and S&P Cap IQ, although we don't look at the S&P Cap IQ readers very much because it's mostly bankers. But it's been eye-opening to see the level of engagement we get on our research reports for company-sponsored research, because it's a better list of names reading our research than any firm I've ever worked at. So, and I think that goes to what's happening in the marketplace, which is the sell side research has been restricted so much because they desperately try to monetize it. Right? It only goes clients of Bank A get Bank A research, and that's it. So when there is research on the Bloomberg terminal like ours that they don't have to have an entitlement for, it gets read like crazy. So yeah, I mean, we get a spreadsheet every month from all those places, and it's tens of thousands of lines long.
Yeah.
So I think I don't think there's a credibility issue, but I do think that this restrictions, both MiFID and what the sell side has done here, trying to desperately monetize their research product, has only helped our business. And I think next year is going to get even better.
I'll just add to that, in addition to obviously the research side, what can an IR do? And I kind of mentioned already going direct to the buy side, but we've seen a ton of that. And we see that we have firms that are taking 60, 70% of their interactions with corporates direct without brokers. Again, they're not cutting the broker out, but you have a duty as a corporate IR on the corporate space to understand and tell your story and get in front of people. So you can do more of that. The other big shift is, not to get into a whole other topic, but stewardship and ESG. You just see more companies naturally having those conversations around governance issues, et cetera, which never included brokers. But there will be a merging of this kind of concept of engagement and this concept of corporate access as those things become closer. They're just discussions with investors. And the bottom line is more corporates are taking that on their own shoulders. Yes, it's a logistical challenge at times. It's not a replacement for going to the Morgan Stanley Tech Conference or whatever. But it's just part of your toolkit to be out and tell that story. And then also find those analysts that don't cover you and say to them, listen, let's do a roadshow together. Hear investors talk about us. Hear that investors care about us. You should be picking up coverage and trying to expand it that way. And, part of what your ammo is to them is say, we'll attend your conference. We'll do a roadshow with you each year if you actually covered us. But, let's do one for free. And you can hear that investors actually really care about our story. That's another way to kind of drum up support. It's hard. It's grassroots kind of stuff. But over time, I have seen analysts, they want to cover what the buy side cares about. So sometimes they need to be convinced that the buy side is actually, it's a name that's worth their time and coverage.
Okay, there's we still got a little time left, so put your questions in the chat, and there's a good one here. The question is, creating good independent research content is great, but how do you distribute it to the buy side? How do you make sure the right investors use it?
That our model, and Theo can talk to his model, is we distribute to everyone. It's open access content. So the buy side and the sell side, everyone uses terminals. So terminals is probably, if you're an institutional investor, you're using a terminal. So if it's showing up on the terminals, it's right next to Goldman Sachs or Morgan Stanley or any other of the big broker dealers. They click on our content or Theo's content, it's open access, so you can read it. You click on Goldman, you got to be permissioned. So from that perspective, it's, you understand it. Now, as far as targeting individual investors, we do that ourselves. So we have sectors that we know, and we have investors that we know in particular sectors that we send our content to as well. We do the natural, I think Theo probably does the same thing, where you pull a comp list of all the companies associated with your organization, all the investors, and we send content directly to them as well. So if you're thinking about targeting, that's a good way to target, right? Is if an investor's invested in a similar sector, similar name to yours, then they might be a viable candidate to be a good investor for yours as well. So that's kind of the angle that we take. We try any and everything to send the content research out to all viable investors, and that could be from retail all the way up to institutional. And as far as targeting goes, it's really just sort of a grassroots effort, kind of what Mark was saying, is really trying to understand who is interested in particular sectors, and who could be someone that could take down stock. So I don't know, Theo, do you have any?
Yep, same thing. There are, since you don't know where the investors are, we don't know that which investors using FactSet, which investors using Bloomberg, which investors using S&P Cap IQ. So it's incumbent upon us to make sure that we have permissions to put our research product out on all the platforms in the United States, in the EU, and in China. And then we get feedback from who actually clicked on the reports. So in terms of distributing it, it's not like a mailing list. It's a self-selected group of people who click on our reports, and then we find out who they are. And we can find out that we can't find out necessarily that they click on the report because we put it in the news feed of a peer, but it doesn't really matter, because if they've clicked on it, there's some interest, there's some level of interest. And so it finds itself. If you put decent content, couple of things. If you're on Bloomberg, if you're a company-sponsored research provider on Bloomberg, you've already been vetted. Bloomberg doesn't want crap on their platform. They only want stuff that people care about. So if you're on the Bloomberg platform, you're already accepted. But obviously, if you write decent research, you get a reputation for it, and people read more of it.
I think that's a great point, Theo. Actually, we started our firm relatively recently. It was only 2 or 3 years ago, based on this model. And when I got here, I used to work at S&P. And so when I called them, they actually said, "Oh, we don't do corporate sponsored research." I'm like, hold on a minute. That our business model is different. We're writing it from sell-side equity research analysts, and we send it over, and they're like, "That's fine." So Theo, you made a good point there. If it's on these terminals, it's already been vetted. And then the idea is, if you need to target, we are targeting. We're targeting the entire universe that whittles down to, again, John or Theo or Mark opening content, reading it, and then going through that vetting process from there. We work directly with the IROs. All of this data we collect, we work with the IROs at these organizations to help them understand what it is. Maybe they hire someone like Mark as well. So, we work well within the whole entire environment, because it's you that's paying for it. So we're you're our client, and we try to get as many investors and content and in distribution out there as possible. So.
Mark, anything you want to add on the topic?
Nope, I think that covers it. I mean, I look, at the end of the day, PMs and analysts on the buy side, they know what's quality and what's not. It's very simple. They read it, you get a brand, they keep reading it. If it's no good, they just stop. And these guys don't waste their time. So I agree.
So there's a great comment or question, I don't know what to bin it as, on the chat from Thomas Ramsey. "I don't believe that this entire issue has been covered in the financial press. This is an opportunity for one, maybe all, of the panelists to get good press for them by writing a good article. What say you, panels?"
That's a very good point. And yes, I would love to get an article written in Bloomberg or the FT or the Wall Street Journal, but that's not as easy. It's easier said than done, but yeah, that's definitely something that we look forward to doing in the future. If you have any contacts for me, please let me know. I'm sure Steve's going to say the same thing.
Yep. Yep.
So there's another question. How does one prevent insider information to prove an analyst's value? I don't know.
How do you insider information? So we run a full compliance on our organization. So my background is a little bit, I think, John, you mentioned it. I've been at the big banks for a long time, so I'm very compliance driven. So we run a full compliance program. It's material non-public information, MNPI is what it's called on the internal side of things. So we run a compliance organization. If any analyst has MNPI on a company, they cannot write on it until it becomes materially public into the sort of the ecosystem of the investable market. So I'm not sure exactly if that's answering your question, but essentially it's on each individual business, like Theo as well. He could be presented with MNPI as well, but it's prohibited for him to, or any of our firms like myself, to disseminate information or act on any information that's not public. So
that's right. That's right. And since I am still registered with FINRA, I, as a sell-side analyst working for Ascendiant Capital Markets, I have to adhere to those rules.
Right. So and that's a good point to bring up, is when you are vetting firms like Theo's or mine or someone like that, you want to make sure that those organizations are run in a compliant way. You're not just attaching to yourself to a name brand that's just like, I just need research, I just need content, let's get it out there. You just want to make sure that you're working with a professional organization like Mark's, Theo's, or or mine.